In finance, not all randomness is chaos, some patterns repeat with remarkable consistency. One of the most powerful patterns is the normal distribution, also called the bell curve. It shows how most events cluster around an average, while extreme outcomes become less likely. Imagine plotting the daily returns of the S&P 500, most days show small gains or losses near the mean, while huge crashes or rallies are rare. This shape, that beautiful curve, is the heartbeat of statistics, risk management, and modern finance. Welcome to the Option Guy, where we turn complex finance into crystal clear insights. Let's break down what makes this curve so powerful. The mean, mu, represents the center, the average value. The standard deviation, sigma, measures how spread out the data is. In a normal distribution, about 68% of outcomes fall within 1 sigma, 95% within 2 sigma, and 99.7% within 3 sigma. For example, if the average daily return of a stock is 0% and the volatility, sigma, is 1%, then about 95% of all days will have returns between -2% and +2%. This isn't just theory, it's how risk managers, portfolio analysts, and quants measure market volatility and probability every single day. To compare different datasets, we use the standard normal distribution, a version of the bell curve where the mean mu equals 0 and the standard deviation sigma equals 1. We calculate how far any observation is from the mean using the z-score. Z equals \frac x, mu, sigma. For instance, if a stock's daily return is +2%, the average mu equals 0%, and sigma equals 1%, then the z-score is +2, meaning it's 2 standard deviations above the mean, a rare event occurring only about 2.5% of the time. Risk analysts use this z-score to measure tail risk, identify extreme events, and quantify how unusual a result really is. The area under this curve represents probability, the chance of an event occurring. For example, the area between 1 sigma and +1 sigma equals roughly 68%, meaning there's a 68% chance an outcome lies within that range. In risk management, this concept is critical. Suppose you manage a portfolio where the average daily return is 0% and sigma equals 1%. Using this rule, you can estimate there's only a 2.5% probability of losing more than 2% in a single day. This is how portfolio managers use statistics to predict losses and set confidence limits around potential risks. Let's bring this to life. When you chart thousands of daily returns from the S&P 500, you'll see something close to a bell curve. Most days show small, predictable movements near the mean, perhaps +0.5% or -0.5%. But large movements like -5% or +4% are rare, sitting far out in the curve's tails. This shape helps traders and analysts visualize market stability, anticipate volatility, and prepare for rare but impactful events. The normal distribution is used across finance. In portfolio theory, it helps measure diversification and expected return ranges. In risk management, it's used to calculate value at risk, VaR, and volatility. In derivatives pricing, models like Black-Scholes assume returns are normally distributed. For example, an options trader estimating the price of a call option uses the bell curve to determine how likely it is that the stock will end above the strike price. Whether you're managing a hedge fund or analyzing risk as an FRM candidate, this curve defines how professionals interpret uncertainty. But remember, even the most elegant models have flaws. Real markets are not perfectly normal. They often show fat tails, meaning extreme events happen more frequently than the bell curve predicts. For example, the 2008 financial crisis was theoretically a Six Sigma event, something that should occur once every millions of years. Yet it happened in our lifetime. So while the bell curve is powerful, finance professionals adjust it with real-world corrections, using skewness, kurtosis, or simulation models to capture reality more accurately. The normal distribution is the language of probability. It's how analysts and traders convert uncertainty into measurable risk. From predicting volatility to valuing portfolios, this curve helps finance professionals quantify the unknown. As you study for your CFA or FRM exams, or navigate real markets, remember. Behind every trade, every risk model, every decision, there's a bell curve quietly shaping your world. This is the Option Guy, simplifying finance, one concept at a time.